Hi, my name is Reed Silverne. The name of this show is Fed Pride. Reason it's called Fed Pride is because I'm a federal worker and there's a problem, and proud of it. Everything that you see is live to tape, which means that whatever mistake I made, just like that, I do it on Friday, the 22nd of August, and you see it on Sunday, the 24th, or on Tuesday, the 26th, or if this is a keeper, sometime in the future. The fact of the matter is whatever I talk about is probably going to be obsolete by the time you see it, and that's the way we like it. We like our lack of professionalism and the fact that we get to talk about lots of good things and with a map of the world. I'm going to spin the world, and I'm going to go to Pakistan over here. But first, I'm going to talk about something that I talked about a long time ago, and there's been some more information on it. And that is that 9-month period when the price of oil skyrocketed. And not only oil, but all of the other agricultures as well. And I started researching it. I was going into the Commodities Funds Trading Agency, CFTC Commission, Commodities Funds Trading Commission, CFTC, and I got friendly with one of the guys over there and got some really good information. And it ends up that commodity trading, which had been very, very highly regulated until the year 2000, was pretty much, I'll put it very, very bluntly, screwed up by a law called the Commodities Modernization Act of 2000, which basically said that if a company, first of all, if a company trades in energy on a off the count or other than regulated or electronic exchange, or if a company, if a hedge fund has qualified investors over 500,000, or if it has sophisticated persons who have $5 million in worth and $1 million invested, or if a trader is a stockbroker or an investment bank or is regulated by anybody but the CFTC, the CFTC can't ask for information and can't control them, basically. What they did is they gave exemptions to these companies. Now, the CFTC kind of passively resisted this whole thing. So it took 3 years for them to issue the rules that would basically open up unlimited manipulation of the market by these characters that were going to do it. And of course, they claim that, we're just like the buyers and sellers and shippers that use the commodities markets, the futures market to hedge. What is hedging? Basically, I am a farmer, I sell cotton, and I want to, the market today is $10 a bale. I don't know what, the cotton market is. So what I do is I buy a future so that when I deliver it to you and when you take delivery of it, I'll get my $10 a bale. And if it goes up, then of course I've made money. But if it goes down, I still got my $10 because I have a future. Same thing with the buyer. The buyer actually buys the cotton. It's going to be delivered to New Orleans or wherever in 30 days. And the price now is $10. I'm afraid that the price might be $12 when I take delivery. I buy a future at $10 so that if the price does go up, I still get the difference. So that's what commodities trading is all about. And that was put into effect in 1934. It's called the Commodities Exchange Act of 1934. And the only people that could buy a lot of anything were what they call commercial traders, and they had to either be buyers, sellers, or shippers of a commodity. They basically had to have the ability to take delivery of whatever it is. If they were trading in oil, they had to have a big oil tank. If they were trading in cotton, they had to have a building. If they were trading in grain, they had to have a grain elevator or a ship to take it in. So basically, they had to be in a position to take delivery. Now, they did allow some speculation, and they had to issue a report that said, I am a speculator, and I'm in this market to make money on trades. I'm not there to take delivery of anything. They were very, very strictly regulated. They were only allowed to take a maximum amount of contracts. They had to report their trades if they were over a certain level, called large trade report. And they had to have a limit on margin. They couldn't just say, I'm going to put up $1 and then take possession of $10 billion in oil or natural gas. And that all went by the wayside in 2003 when the CFTC finally issued Rule 4.13 and deregulated the electronic trading market. So that is what the problem is. And this exception was lifted in April of 2008, or either March or April, with the Agriculture Trade Act. And if anybody remembers, George Bush vetoed it because they were giving out too many subsidies to farmers. Well, I don't know. When has George Bush ever had a problem with subsidies to farmers? Until this year. The real reason was because they had put a clause into that Agricultural Act of 2008 that basically said the CFTC can collect data on all commodities trades, whether there's an exemption or not, and can make rules. It can make rules on these exempted companies. So all of those exemptions were put in place in the year 2000 by Enron lobbyists. And so it's called the Enron exception, even though Enron collapsed, fortunately, otherwise this country would have been in real trouble in 2001 instead of in 2007 and 8. But we ended up becoming in real trouble in 2008. The price of oil from 2007 to 2008 went up about 3 or 4 times. At the bottom in like 2002 or 2003, it was down to $20 a barrel. It topped out at $147 a barrel. And today, which is Friday, August 28th, it's about 119, way down from its top, but still very, very high enough so that American people who are fed up are going to go buy hybrids, which is another story. So all this background, what does it mean? Well, what it means is that the CFTC was able finally to start collecting data on who is manipulating the oil market. And I have to say, the agricultures were going up and up and up. The price of rice went up 3 times. The price of wheat doubled. So this wasn't just oil and natural gas. This wasn't just energies, although they went up the most. It was being pushed up all around the place by mysterious trades that nobody could get a handle on. Okay, I am going to bring up a chart, and I'm hopefully going to get rid of the stupid... didn't work. All right. See if I can get out of that. Oh, these bastards. Okay. Okay, that didn't work out. It's not letting me go back. So anyway, I had a chart up there, and this is the kind of thing that we just love for Fed Pride, because what you see is what you get. And around June, there was a case where the prices had charged up from the low 100s all the way to $135. And Goldman Sachs and the big giant investment banks were all saying that there was a tightening, there was a tremendous amount of increase in demand, which was false. Because actually demand in the United States went down 800,000 barrels a day. And the previous year had gone down another 200,000. So there's been a tremendous decrease in demand in the advanced world. There is some increase in demand in China, and that increase in the developing world was actually slowing down and much lower than the increased amount of supply that was coming online from Canada, Brazil, and certain other countries, Colombia, that were discovering oil and whose oil was going to come online the next couple of years. So it was absolutely, the supply was growing, it wasn't going down. There was too much gasoline being produced in the United States. So every fundamental said that oil is going to collapse. And here, starting in 2007, it was about $60 a barrel. It had gone up to the low hundreds early in the year in January, March, and April, and then it charged up to 135, and it looked like it was going to go up to 150 or 200, according to these investment banks. And the investment banks, there was a different excuse every time it jumped up. Well, the real market, the actual people that buy, sell, ship oil, were selling short. And in fact, one of those companies, Sem Group, actually went out of business because they sold short because the fundamentals were so against what was going on in this market. And then on a certain day in June 6th, and I did a show that week about it, the price of oil had gone down from the mid-130s down to 123, and I said, I will bet you they will push it back up. And they did. It went up $4 at the end of the trading day the previous day and $11 the next day. So it went up a total of $15. And it spiked up at 138 and eventually went up to 147 by July 11th. Well, now, after all this time, they know why. And one of the reasons was a company called Vitol in Switzerland. So let's go to Switzerland over here. And here's Switzerland right down there over my shoulder. And this company called Vitol is a $100 billion energy trader. And they were actually, they were on some regulated markets and some unregulated markets. And on the regulated markets, they were saying, we are commercial traders. We are trading for the shippers, the buyers, the sellers of oil in Europe and the United States and the Far East. And we represent people that are not speculators. We represent the real industry. So their trades were actually reported, when they were reported, which wasn't very often, as commercial trading. But in fact, what they were is they were the swaps dealers for Goldman Sachs, for Merrill Lynch, for all the big hedge funds and investment banks who were issuing derivatives, and I've talked about that before, CCOs, based on pools of commodities. Who was buying and selling those pools of commodities for them? It was this company called Vitol. In June 6th, the day that the price spiked over $11 in one day, and I remember that day very, very well, June 6th, it looked like the prices of commodities and energy was going to keep on going up until it broke the back of the developed world. And basically, these folks held 57.7 million barrels of oil just on the NYMEX alone. We don't know what they were trading on the ICE, which is the Intercontinental Exchange, which claims it's in London, but where is it? It's really in Atlanta. It spiked the price of oil $11 to 138.54. And then, of course, it bottomed out at about 112 in August. So what does that mean? Well, that means that the new system that had been set up by this Commodities Modernization Act, which was broken, at least as far as financial information is concerned, by the Agricultural Act of 2008, that now the CFTC can actually find out who is manipulating the market. You are allowed to buy and trade. You are allowed to say, I think the price is going up, I'm buying. I think the price is going down, I'm shorting. What you are not allowed to do is to corner the market so that you are such a large player in the market that you personally are forcing the price up so that you can benefit from it. That is called fraud. That is called fraud. That's fraud in Europe. That's fraud in Switzerland, that's fraud in the EU, and that is fraud in the United States. And that is punishable by jail. Are we going to see any indictments? I doubt it. There was another case where a guy was hedge fund trader Paul Eustace. He had to pay $280 million to the defrauded customers and $20 million in penalties to the CFTC. Did he get indicted for criminal indictment? I doubt it. Same thing with a fellow named Peter Hunter up in Calgary, who cornered the natural gas market in 2006. Pumped it, dumped it, pumped it. That guy ended up losing $6 billion. Now, he had made $3 billion of it, so he really lost $3 billion. Excuse me. But that is billion with a B. That is the scope of fraud that is going on in our markets today. And now, I'm happy to say that because the CFTC is now on the job, was not allowed to be on the job until March of this year, literally, not allowed to be on the job, not allowed to get reports on trading on unregulated markets, on the over-the-counter markets, the CBOT or this ICE, not allowed to get reports from foreign customers, and not allowed to limit the manipulation of the market that is causing harm to this country, causing harm to everybody that has a car, that needs to get to work, and that gasses up their car. Is it just the car? No, these same people were manipulating the markets in wheat and causing riots in rice and causing riots in Mexico and in India and in Egypt. There's no excuse for it. Absolutely no excuse for it. And they were claiming that they can manipulate the market all they want. They can overinvest. Now, the 57.7 million barrels that just one company held, and they say that there's about 11 of these companies that are cornering up to 81% of the crude oil markets. And I think that they're going to think twice about it now that they're, the CFTC did not name this company. It's called Vitol in Switzerland. They did describe the circumstance, and everybody knew. Two industry insiders went to the press and said, that's Vitol in Switzerland. And they are cheating. They cheated the market. They raised the price of gas, of crude oil by $11. They kept the price of gas much, much higher than it deserved to be, according to supply and demand. And they cheated the American people out of billions and the European people out of billions of euros. So what is the result of that? Well, the result of that is previously our regulators could not even know. They couldn't even collect data that would tell them what is happening on these other markets and how is it impacting our market. And they couldn't collect data on large trades by these exempted companies. And what were the exempted companies? A hedge fund where every investor had $5 million in assets and was an investor of $1 million, not necessarily in that company, but he had to be that wealthy. I always thought, why have a rule? Or why would any hedge fund manager limit his market of the people that can invest in his company to people who have $5 million and invest $1 million. Until I read the actual regulation that was put out by the CFTC and was reflectant of the law from 2000 that made a specific exemption for hedge funds whose investors were all sophisticated persons. Another one of the exemptions was any foreign entity, company, and offshore. And of course, a lot of the Americans were investing in offshore funds that were set up by the same, Goldman Sachs, Merrill Lynch, you name it, the same companies, except that they were pretending to be offshore funds and pretending to be a foreign person, because that was another one of the exemptions. And the other exemption is an entity that is regulated by another agency. So therefore, any investment bank, which is under the control of the SEC, or I forgot what agency controls the stocks. I think that might be SEC too. They were exempted from reporting to the CFTC. So the CFTC sat back, and they were forced to sit back because these are folks, and I've talked with some of them. I haven't met them in person, but I've met them over the phone. I've talked with them. They are people that want to do the right thing, and they want to do the right thing for America. And what people don't realize is they went to Congress. They bypassed the administration, and they actually put in a suggested bill into the Democratic Congress in October of 2007. These are Republican appointees to try to get some oversight over these markets because they could see that these very, very large issuers of these complex derivatives that are completely dependent, and their value is dependent on having an ever-increasing price of commodities. So the interesting thing about this article about Vitol that was in MSNBC is that they actually mentioned that Vitol's customers were Goldman Sachs and Merrill Lynch, which is fascinating to me because those are some of the investment banks that were issuing what we call CCOs, which are basically bonds based on pools of commodities. The bondholders don't own any of the commodities. It's the same exact scam that destroyed the housing market with the subprime mortgage derivatives. They're the same thing, but they're based on commodities instead of mortgages. And basically there's a swap out there, and this is the company that handled the swaps, so that every time the price went down below each trigger point, the buyer of the bond, his actual principal would go down by that amount. Every time it went up, a swap would come to fruition. A swap is basically, I pay you $100 a month, and then when an event happens that I have, it's like an insurance policy, I get a certain amount of money and a guarantee from you for this amount of money. So basically they were taking the swap money, they were paying off the interest rate on these CCO phony fixed income bonds, and then however, if the price goes down below the lowest trigger point, the entire CCO becomes completely, totally worthless. This is what happened with subprime mortgages. Their swaps were based on the default rates. When the default rate went up, not a devastating amount, from 0.5% to 1.5%. Still, 98.5% of all mortgages were fine, and probably the mortgages in the pools were fine too, although they were bad mortgages in a lot of these pools. It became completely and totally worthless. The market for them froze up, and $500 billion disappeared in value. And that can happen in commodities as well. But now we know how these prices were manipulated up. An $11 move on June 6th when this one company cornered 55 million barrels of contracts for a market of which there were only 2 million barrels a day. My name is Reed Silverne. Name of this show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker, retired and rehired. And thank you very much for watching.